Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on Enphase Energy for the 2021 outlook and beyond. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both the short term and the long term. So let's get right into it. So Enphase Energy is a provider of energy management solutions. It is engaged in designing and developing, manufacturing, and selling microinverter systems for the solar photovoltaic industry. Its semiconductor-based microinverter system converts direct current DC electricity to alternating current AC electricity. Its microinverter system consists of four components: the Enphase microinverter, the AC battery, the Envoy gateway, and the Enlighten cloud-based software. Its Enphase microinverters provide power conversion at the individual solar module level by a digital architecture that incorporates custom application-specific integrated circuits, or ASIP or ASIC, specialized power electronics devices, and an embedded software subsystem. Envoy bi-directional communications gateway provides collecting and sending data to Enlighten software. Enlighten cloud-based software provides the capabilities to remotely monitor, manage, and maintain an individual system or a fleet of systems. The company is basically the world's leader supplier of microinverter-based solar plus storage systems. Now let's look at some news of the company. So Enphase Energy storage system now is compatible with existing M-series microinverter-based solar systems on approximately 300,000 homes. The expanded capability provides approximately 300,000 additional Enphase system owners with the possibility of achieving grid-agnostic energy resilience through the Enphase upgrade program. So that's definitely good news, so that you can upgrade your old technology with Enphase and you stick with Enphase as you upgrade throughout. But let's go ahead and look at some of the fundamentals of the company. The company's current market capitalization is currently $26.79 billion, which is basically $10 billion over its direct competitor of SolarEdge Technologies, competing for the same market share. But both of these companies are overvalued in my opinion and fundamentally, but I will get into my thoughts about that later. Revenues have been steadily increasing over the years, with a big jump from 2018 to 2019, with $316 million in revenue to $624 million in revenue in 2019. Earnings are definitely forecasted to grow about 34% per year. Earnings grew about 282.5% over the past year. Let's bring it back here. The projected revenues in 2020 are going to be about $763 million, with earnings of $102 million, and that's going to come out soon. Its projected revenues and earnings in 2024 are significantly increasing to about $2.6 billion in revenue and $525 million in earnings. That is definitely a significant thing to note, because the current stock prices right now are taking those numbers into current calculations and the human psychological factor of running up stocks right now. Shareholders have been diluted in the past year, with the total shares outstanding growing about 3.2% last year. So now let's see what the analysts say about this. The analyst consensus, it is a current buy. 10% are a strong buy, 50% are a buy, and 35% are a hold. 5% say it's underperforming. Now, the average price target of them is $170, with a high estimate of $254 and a low estimate of $96. We're definitely way above the price target of those analysts, but I'm going to definitely explain that in a little bit. Now, going over a few of the analyst reports specifically, New Construction has a neutral rating and does not recommend investors to buy this company. The Ford Research report has a neutral rating as well, and they project that the company will perform in line with the market over the next 6 to 12 months. This projection is based on their analysis of three factors that influence the common stock performance: earnings strength, relative valuation, and recent price movements, but they're not taking in consideration of future Joe Biden administration and the human psychological factor. They said the company has suffered a very negative trend in earnings per share over the past 5 quarters, and while recent estimates for the company have been mixed, the company has posted better than expected results. And they said, based on the operating earnings yield, the company is overvalued when compared to all the companies that they cover. Share price changes over the past year indicates that the company will perform very well over the near term. So this is something I want to emphasize with Enphase Energy, and this is a caution to everybody out there, is that, and put it in your brain, the company is way overvalued based on the fundamentals, but it will perform very well in the short term. That's what they said. So they have a neutral rating, and that's exactly my train of thought, but we're gonna discuss that. Let's go ahead and look at the ownership breakdown of the company. Majority of it's owned by institutions with 77.2%. The second largest is General Public, owns 16%. Public companies own 4.4%, and the individual insiders own 2.4%. And there's something very important to note of what the insiders are doing right now over the past 12 months. Majority of the insiders have only sold shares in the past 3 months. They're basically taking their profits and running somewhere else. It goes back to the overvalued theme of things. But let's look at some analysis. Let's look at the valuation analysis. Because the company is the semiconductors and semiconductor equipment industry subcategory and has positive earnings, the PEG and PE ratio is the most appropriate valuation measures. Now, the price to book ratio is excluded because it underestimates the company's book to value by overlooking hidden assets such as intellectual property. The price to sales ratio is not as meaningful as the PE and the PEG ratio due to the company's positive earnings. Therefore, the company seems expensive with a PEG value of 4.53 times above the semiconductor and semiconductor equipment industry median PEG of 3.05 times. All through their price to earnings is 166.22 times. That is among the highest in the industry. Okay, remember that. Profitability analysis. The company is one of the more profitable companies in the semiconductor and semiconductor equipment industry with a net margin of 24.69%. Its net margin, operating margin are both among the strongest of any peer, while its gross margin is in line with the industry median. The growth rates analysis, earnings growth at the company outpaced revenue growth over the trailing 12 months. This is a trend that is not sustainable if profits are to continue to grow at this rate. However, the result was better than expected and better than the average company in the semiconductors and semiconductor equipment industry, where earnings fell over the period. And going looking at the financial strength analysis, it is one of the most highly leveraged companies in the industry and has a total debt to capital ratio of 46.39%. Additionally, the percentage of debt used in its capital structure grew this year, with an interest coverage ratio of 8.8 times and a quick ratio of 3.17 times. The company should be able to comfortably repay its debt. So in my buy, hold, or sell recommendation on Enphase Energy for the short term and the long term, here are my thoughts. Now, the Enphase stock enormous rise in 2020 has sent its valuation to the moon, basically. It is trading at a price to earnings ratio of 133 approximately, a forward price to earnings ratio of 93 taking in consideration the forward looking projections, and price to sales ratio of 32. While the company is well placed to grow itself, it would be difficult for it to maintain such high growth rates for long. Having said that, though, in 2021, the company will likely be able to maintain current revenue growth rate as well as margins. That may keep the stock price largely elevated in the coming year. So taking fundamentals, it being overvalued, analyst projections kind of mixed, future outlook, which is significantly positive. I'm a short-term bull, but a very cautious long-term bull. And let me explain why. That long-term bull might turn into a long-term bear based on some economic factors in the future. I currently place a fair value of Enphase Energy at around the $230 a share mark, but that's way above the fair market value. But based upon the human, psychological, and political economic factors that are in play that bring it way above the fair market value fundamentals of the company. And with the current price of $202, it could be a good time to buy in. But please note that this, if you're a conservative investor, this has higher risk than most stocks that you would want to get into. Do note that today shares of several technology companies are trading lower today following a midday sell-off in stocks. The sector had a strong run-up in 2020 and continued to be volatile going into the earnings season. But I foresee it breaking through, and I would target a 12-month price of about $270. But we also have to be aware that the Enphase shares have risen to 100 times during the past 3 years to potentially an intermediate term long bought position. The company's differential product, operating leverage, and regional advantage in the U.S. market could still provide significant earnings growth in the long term. Market momentum and positive news flow could still potentially result in further multiple expansions, albeit with larger, greater volatility risk. But be aware that if the market turns, this company would follow suit as well. Enphi's current valuation is well above the industry average during the past decade. If and when the market sentiment changes, its stock will eventually have to settle at valuation supported by its earnings. This is why I'm a very cautious long-term bull. If and when the market corrects in the future, no idea of when that would happen, whether it be 6 months, tomorrow, or a year, or 5 years, is when I would turn into a bear and take my profits and run. I am generally optimistic, but renewable energy under the new administration and foresees solid secular growth in solar power going forward. Ultimately, Biden is said to be dedicated to zeroing out U.S. electricity sector carbon emissions by 2035, with a potential $400 billion in federal funds being directed to this goal. So there's probably still plenty of room for renewable energy stocks to grow over the next 4 years and beyond. I project that Enphase will likely grow with the U.S. residential installations and possibly even take market share away from its direct competitor. The commercial segment should be the company's next major growth opportunity. Enphase's new IQ8D microinverter, which is currently in beta testing right now, is targeted at the 50 kilowatt to 200 kilowatt commercial market. Most installations, though, using Enphase microinverters today are residential and under 20 kilowatts in size. And hopefully there's going to be a significant increase in presence in the markets overseas, especially in Europe. One of Enphase Energy's weaknesses right now was its geographic concentration in the United States. The company generated 84% of its 2019 revenues from the U.S. However, Enphase is working to expand its global operations. In the latest quarter, of 22% of its revenue came from outside the U.S. The company is hopeful of generating roughly 30% revenue from international markets by the end of 2021. So there's significant future potential growth in international markets, not alone the U.S. market. Now, Enphase Energy growth in Europe is particularly impressive. Its revenues from Europe has grew 67% in Q3 of 2020 alone. So there you have it, folks. I am a cautious long-term bull. I'm a short-term bull. But if the market turns, this is going to turn with it. As always, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you like to hear daily stock recommendations. Until the next stock update later today, ciao.